I think we'll get started. Welcome, everyone. The format for this panel is that each speaker is going to speak for about 20 minutes, and then afterwards we'll open it up for questions from everyone. And our first speaker is Stephen Berger from Citadel.
Thank you. So I guess I'll dive right in. Our view with respect to markets and market reform and market regulation is that the needs of all market participants and the broader economy and financial system are best served by markets that are fair, open, competitive, and transparent. So I wanted to explore those themes with respect to a few different markets and maybe highlight how reforms have helped achieve these objectives and where they've fallen short in achieving those objectives. So I'm going to talk about the OTC derivatives markets, and then the treasury markets, and then the equity markets, and then provide a few concluding thoughts at the end, and then turn it over to some of the luminaries up here who can correct me where I've gone wrong. So the OTC derivatives markets were obviously a market that was targeted by the post-financial crisis reforms. Prior to the financial crisis, I think it's fairly well documented that the OTC derivatives markets, and we're talking here about the interest rate swap market and the credit default swap market, among others, these markets were very complex, interconnected, opaque, under-collateralized, the list goes on. So there are a lot of, I think, flaws in how those markets were operating. It's our view that the reforms that have been brought to bear in those markets have actually been extremely successful. The chief reforms were the introduction of mandatory central clearing, the introduction of a requirement to trade certain liquid standardized derivatives on regulated trading venues, the introduction of reporting requirements that allowed regulators to have a view into the activity that was going into the market, but then also to provide market data in real time to the public at large and market participants at large. So I think these reforms, where they've been implemented, and I think there's been a divergence both domestically and internationally with the pace of implementation, but where these reforms to our OTC derivatives markets have been made, they've made the financial system safer, and they've also improved the pricing and liquidity by making the markets more open, competitive, and transparent. Just a few statistics. If we look just last year in 2016, at LCH, which is the largest clearinghouse globally for interest rate swaps, over $665 trillion in notional of interest rate swaps was cleared at LCH, and that was represented over 3.8 million individual trades that were centrally cleared. Importantly, 139 trillion of that was clearing that was done by the buy side, by the end user community. So it's not just clearing between the largest banks in the world. End users, be they asset managers, insurance companies, pension funds, corporates, are all now able to access the benefits of central clearing as well. And in terms of efficiencies that central clearing has delivered, over 384 trillion notional in interest rate swaps was compressed at LCH last year. So effectively, because market participants had positions that were offsetting, they were able to effectively collapse those positions and remove them from their balance sheets. So that is a good, we refer to it as portfolio hygiene. It allows you to clean up your portfolios and remove outstanding credit exposures that you would otherwise have. So that's one of the efficiencies that central clearing brings. There have been similar, stellar volumes in central clearing at some of the other big CCPs, such as CME and ICE as well, but I won't bore you with the numbers. I think one thing that's important to realize with central clearing is that I think the benefits of it are often underappreciated. I think there is a lot of focus on how you move from an interconnected system where each market participant might have bilateral exposures to 20 other market participants, and you can concentrate those through a CCP so that you get benefits in terms of netting of counterparty credit exposures and the ability to do this compression. But there's a lot of other benefits of central clearing as well that I think go underappreciated. So one of the chief ones is that there's actually, in a crisis moment, there's actually kind of confidence and transparency that you can fully appreciate, what exposures market participants have to each other, which is much harder to gauge when, you don't know whether somebody you're facing is facing 10 other people who are potentially in default. So it provides a much clearer viewpoint into what exposures exist in the system between market participants. And it also offers a lot of client protection. So if you're an end user, you know that your margin is segregated and protected, and you're not at risk of losing your initial margin if a bilateral counterparty of yours fails. You have transparent and consistent end-of-the-day pricing. If your clearing member defaults, you have the ability to port your positions to a solvent clearing member. And then the final benefit of central clearing that I think largely gets overlooked is that it allows the trading in the products that are centrally cleared to evolve. So once you separate the counterparty credit risk from your trading decisions, you often can obtain better pricing. You can interact with a greater diversity of counterparties. New entrants can come into the market more easily. So I think the clearing reforms to the OTC derivative markets have been quite successful. The trading reforms, I think, have also been very beneficial, again, where they've been implemented. So in the United States, the transition to trading on what are called swap execution facilities started in February of 2014. And since that time, we've seen a 50% reduction in bid-ask spreads for US dollar interest rate swaps, which is quite a material improvement in pricing in that marketplace. And some research that was done by the Bank of England and released earlier this year concluded that end users in the marketplace were already saving roughly $10 million per day in transaction costs and obtaining better liquidity by bringing these products onto a more open, competitive, transparent trading venues. So just to try to put this in a little, make this a little more concrete, I want to quickly compare what the trading experience was like in interest rate swaps and credit default swaps 5 years ago versus what we experience today when we're trading on a swap execution facility. So previously, the price discovery process was all done by phone or by Bloomberg chat, and you had to individually contact, if you were a buy-side participant, individually contact multiple dealers and request prices. The prices that were then provided to you were typically only indicative prices, and you would have to go back again if you actually wanted to get a firm price, and the firm price you were given may or may not be the same as the indicative price you were initially given. So the process of price and size discovery and actually getting a transaction done was quite cumbersome, and it was more difficult to put multiple dealers in competition. Today, on a swap execution facility, the dominant trading protocol that clients use is a request for quote to at least three dealers. And so dealers are actually now all streaming their prices in real time, essentially advertising that they'd like you to send them a request for quote. And then when you send a request for quote, you typically get 3 responses, usually in a matter of seconds, and they're all firm and executable. So we've gone from indicative to firm pricing. We've gone from it potentially taking minutes to try to access prices and size to being able to click on a screen, get 3 quotes, and then click one of them and be done with your transaction. And the execution to clearing workflow that's been built to support that usually results in your trade from execution to when it's routed to the clearinghouse and accepted for or rejected for clearing, that all happening within 10 or 20 seconds. So substantial progress has been made in the execution experience in the OTC derivatives markets as well. So that is an area where I think the post-financial crisis reforms have really delivered concrete benefits. Again, I'll comment on this a little more later, but those benefits have not been universal because only certain parts of the OTC derivatives markets have had their reforms implemented. So the interest rate swap and credit default swap index markets, we've seen these reforms fully implemented. Those are under the jurisdiction of the CFTC in the United States. The SEC has been much slower in implementing its reforms. So the single name CDS market, for example, does not yet have mandatory clearing or trading. And then if we look across the pond in Europe, we are only now beginning to see the phase-in of the clearing requirement for interest rate swaps and credit default swap indices. That phase-in began this past summer, and the trading reforms I described are farther off. They're part of a separate piece of legislation in Europe called MiFID II that won't come into effect until 2018. So we're unlikely to see that transition to trading on more open, competitive, transparent trading venues for swaps in Europe until later in 2018 or even 2019. So that's some comments on what we've seen in the OTC derivatives market. I think another market that was not really touched by Dodd-Frank and wasn't an immediate focus of post-financial crisis reform, but I think is nevertheless interesting to discuss briefly, is the U.S. Treasury market. The U.S. Treasury market is typically lauded as kind of, the deepest, most liquid market in the world. But a flash rally event that occurred on October 15th, 2014 led both the regulatory community and many market participants to question whether the market structure and the regulatory framework for the U.S. Treasury market had been kind of kept up to date. And so there are a number of areas that have been topics of discussion for reform. One of them that was, I think, surprised a lot of people is that no regulator really had complete visibility into what was happening in the U.S. Treasury market. So there was no central source of data being collected by the Treasury or the SEC or the New York Fed about what was happening in the secondary markets for U.S. Treasuries. So that's one step that's already been taken. So starting next summer, the engine that's used already called TRACE for collecting data on corporate bond transactions is going to be expanded to cover and collect data on Treasury transactions as well. So that'll at least provide the regulatory community with a kind of comprehensive look into what's occurring in the U.S. Treasury market. There's a further step which TRACE already does for corporate bonds, which is disseminating that transaction data in near real time to the public. That's been a little more controversial in terms of whether to expand and apply that to the U.S. Treasury market as well. We happen to be firm believers that there should be real-time public reporting of U.S. Treasury transactions to all market participants. That's obviously a reform that is being considered and was largely endorsed by, I guess, the outgoing SEC chair as well as some Treasury officials this year, but it'll remain to be seen how quickly we can have that further reform adopted. Another area that's being considered in reforming the U.S. Treasury markets is whether all of the venues where Treasuries traded should be registered and regulated trading venues. And we see benefits in, given the importance that some of these venues play in facilitating Treasury market trading activity, they should be, registered and regulated as ATSs by the SEC. And it seems like a little bit of an oversight that most of the other trading venues in the financial markets are actually regulated and supervised, but the ones for U.S. Treasuries weren't. And part and parcel with that is, ensuring that those trading venues provide fair and impartial access to all market participants. Like the swaps market historically, the Treasury markets have operated with different dealer-to-customer versus dealer-to-dealer channels that kind of kept different types of market participants segmented. So going back to the kind of the themes I mentioned earlier, that regulation, I think, is best when it makes markets open, competitive, fair, and transparent. Again, I think we're in the process of beginning to make further reforms to the market structure for the U.S. Treasury market that will achieve those objectives. And then the last market I wanted to kind of comment on was the equity markets. And I think our equity markets are actually an example, and much of this predates the financial crisis. They're an example where innovation and new technology coupled with thoughtful regulation delivered benefits for all investors. So investors in our equity markets, our stock markets, benefit today from dramatically lower trading costs, improved transparency and liquidity, and increased competition by liquidity providers. So, bid-ask spreads are substantially narrower today than they were a decade ago. Displayed depth is larger. Fees and commissions have come down. They're under $10 now for retail investors versus, $25 a decade ago. And retail investors often get price improvement. They get priced at even within the prevailing national best bid and offer. So today in our equity markets, we have more choice and competition. And if we went back 2 decades ago, a given stock would trade on the floor of a single stock exchange in a single specialist post under the control of a single specialist. So we've brought much more competition and transparency and innovation to that market over the past few decades that have resulted in better conditions for all participants in the market. So again, in short, I think the benefits of open, competitive, fair, and transparent markets are real, and regulations that advance those objectives deliver the most meaningful benefits. I was going to comment on kind of the debate around fixed income market liquidity as well, but I'm guessing some of my other panelists may be addressing that topic, and so I think I'll pause here and save my remaining time to interject when I disagree with them.
Sounds good. Thank you very much, Stephen. Next, we have Darrell Duffie from Stanford.
Thanks, Debbie. It's a pleasure to be here. Stephen was kind enough to leave a few of the choice issues confronting us still available, but I'm going to come back and second the motions that he's made with respect to some of the benefits that we've seen in trade competition. Before I do that, I want to step back a little bit and kind of frame the general issue of the financial regulatory reform, what it was supposed to do, and its implications for financial markets. Here, we're not addressing, I think this panel is not supposed to address spillover costs to the general economy of financial crises, which was a big part of those regulations, but rather we're focusing on financial markets themselves. Having said that, there are a lot of financial stability improvements inside financial market performance that are worth considering. In Pittsburgh in 2009, the G20 met and on the tail end or in the middle of this financial crisis laid out a big program which we should not underestimate in terms of size and scope across the G20, including both financial stability and market competition reforms. And in my view, those reforms are perhaps half implemented, but they were ambitious and I think were appropriate in a general sense. There's one or two areas that I think are not working properly. I'll come to those as well. Those financial stability goals were laid out by the Financial Stability Board in 4 areas. I just want to repeat, just so you get a sense, sort of shock and awe of the scope of these reforms. Number 1, making financial institutions more resilient. And here I'm quoting from the Financial Stability Board's report of how it's doing. That means basically making banks, large dealers, and other financial institutions less likely to fail. Number 2, ending too big to fail. Well, that's pretty ambitious, but that means when they do fail, trying to reduce or eliminate the moral hazard of being forced to bail them out, with the alternative, of course, of letting a big crater form in the middle of the economy, which you wouldn't do most of the time. Number 3, making derivatives markets safer. And the center point of that, Stephen just mentioned, was central clearing, but there's a lot of other things going on there, like margin requirements, trade disclosure, trade data repositories, and many other rules that have been implemented in different ways, at different timing, unfortunately, across the world. Number 4, transforming shadow banking. And this one is way too complicated to get into, but you could take one example of a big success story, in my view, which is the reform of money market mutual funds in the United States, which were a major part of the financial crisis in a way that I think is very unlikely to happen now, given the new rules governing U.S. money market funds, and Europe is soon to follow. Now, remember, those 4 items, which were the top 4 for the Financial Stability Board, don't say anything about the performance in terms of day-to-day market efficiency or liquidity of financial markets. But that importance of that was not lost on the framers of the regulations. Barney Frank, when asked, why did you have this stuff about pre-trade and post-trade price transparency, competing on trade platforms and the like, he said, well, no one said that we were restricted in placing our attention only on financial stability. There is room for improvement in market competition as well. So in the area of trade competition, Stephen's outlined some of the main implications, but it's now the case, as he said, that you can, instead of just calling dealers one at a time to buy a bond or get a swap position, you can actually launch a request for quote onto an electronic trade platform. In fact, in the United States, it's required in the swap market that you do that. It's not required in the bond market yet. And you can get competitive quotes. And soon in Europe, that will extend to the bond market. There's no such rule in the US. And even today, only about 15% of corporate bonds are traded on trade platforms. Most of the time, you are still doing the call your dealer, get a price, call the next dealer, get a worse price, call the first dealer again, say, I'll take it, and he says, no, the price has moved since you last called. So that's not what we want to have. Even in the area, I'm starting to be a little bit critical here of how far we've gotten in this direction. Even in the area of improvements in the use of trade platforms, remember what Stephen said about the trade protocol. You, the buy-side firm, calls a bunch of dealers to respond to your request for quote, meaning that although they're competing for your trade, you are paying a bid-offer spread, and you are not given the opportunity to make quotes yourself and take a bid-offer spread from the rest of the market. Now, in some cases, that's completely appropriate because it's too difficult to arrange operationally and maybe not worth it given the breadth of trading activity in certain financial instruments. But in other financial instruments, like plain vanilla interest rate swaps or U.S. Treasuries, I would argue that there should be an opportunity for large institutional buy-side firms to more easily get onto these trade platforms. Citadel, Stephen's firm, has successfully done this after some number of years of working on this. You can Q&A, you can ask him how do they manage to do that. But it's not easy to arrange, and I think it should be somewhat easier. In this platform-based market, the platforms are also fragmented. So you can't get all dealers in the world to compete with you on your platform. You can go from platform to platform, which is kind of like a multiple platform version of what we had before in the one-on-one dealer-to-dealer search for trade. The degree of liquidity that we have in OTC markets is still to a large extent determined by the cost of getting space on the balance sheets of the largest dealer banks in the world. So not necessarily just in bid-ask terms. Let me explain that. It's in the corporate bond market, bid-ask spreads are actually lower than they have been. But the time that it takes to get a trade done is longer. The ability to get large blocks done is longer. The likelihood that when you call a dealer, they will immediately take your position is lower. They're more likely now than before. This is from research by Trebbe and Shao and some other work by Hank Bessenbinder and co-authors. They're more likely than before to say, hang on, you hold a position, I'm going to go find a buyer for your bonds, and when I find a buyer, I'll call you back. So the inventory space on the dealer's balance sheet is smaller than it was. Why is that the case? There's two potential explanations for why dealers are less likely to give up space on their balance sheets than before. One is capital requirements, and there's nothing in Modigliani and Miller that says that capital requirements should make you indifferent to adding new things to your balance sheet. And another possibility are either regulatory things like Volcker rule or headline risk associated with taking a significant risk on a position and then suffering a loss. There's still some controversy. There's a paper by Bao, O'Hara, and Joe that attempts to get to the bottom of whether the less liquid corporate bond market is due to capital requirements or the Volcker rule. They reached the conclusion it's more likely to be the Volcker rule, and they have some persuasive arguments, but I think the story is not completely over. There's still an important role for capital requirements. There's an area in which we can definitely see the big impact of capital requirements on market liquidity. And as I describe this, please don't get the impression that I think this is necessarily all a bad trade-off. We probably had too much day-to-day market liquidity before the financial crisis, before these regulations, in that dealers were willing to expand their balance sheets like an accordion to absorb very large amounts of risk relative to their capital. And the cost of getting a place on the dealer's balance sheet was pretty small, too small probably relative to the financial stability costs associated with very large balance sheets with thin layers of capitalization. Now we've moved toward a more, well, a better trade-off on average, but that's not to say that It's better in every respect. I'm going to give you the poster child of where I think we've gotten a bad trade-off, and that's the area of which is called the supplementary leverage ratio. So let me explain what that is and explain which market you would expect this particular capital rule to cause an undue distortion. So the supplementary leverage ratio as applied to the U.S. bank-affiliated broker-dealers, the largest ones, says that for every $100 of assets, you must have $5 of capital. It's a 5% rule, and nowhere in there is there any mention of risk. So this rule is insensitive to risk, and if you do your corporate finance and you know about asset substitution or debt overhang, you would understand that a dealer would be under this restriction, if it's binding, which it seems to be for the largest U.S. dealers. You would be more inclined as a dealer to take a riskier position with a large bid-ask spread than a very low or very safe position at a very small bid-ask spread when they both need to be backed by the same amount of capital per unit of assets. What's happened in the U.S. Treasury market, repo market for U.S. Treasuries, is that in light of this supplementary leverage ratio rule, the bid-ask spread in Treasury repos has climbed from 3 to 4 basis points pre-rule to on the order of 15 to 17 basis points, depending on when you measure it now. And the volume of trade in the interdealer Treasury repo market has shrunk, depending on which measure that you use, by 20% on average and 80% if you are a non-bank affiliated dealer in that market. So the cost and volume in that market has been severely affected by this rule. Why? It's not because Treasury repo is a very risky operation for these banks. It's simply because this rule requires that dealers set aside a lot of capital for a safe position, which means that creditors are going to be safer taking wealth transfer from the equity owners, at least until banks get so highly capitalized that there's no more wealth transfer that's possible. This is an area in which we're not at the efficient frontier of day-to-day market liquidity and financial stability, because we could achieve same financial stability and more market liquidity by assigning a higher risk-weighted capital ratio and making the leverage ratio less binding. Let me say that again. If you increase the risk-weighted capital requirements, this leverage ratio rule would not be binding, and dealers would not be faced with a very high capital ratio relative to the amount of risk they're taking in the Treasury market, in the Treasury repo market, which is a very important market. Another thing you could do is to carve out certain asset classes like Treasury repos, or as the Bank of England has done, central bank deposits from the application of this rule. Do I have any more time left?
Yeah, you have a little bit of time.
Okay, great. Some other things that that banks have been doing because of these higher capital regulations, which are good, include things like reducing the number of prime brokerage clients that they have, which are not that profitable, because prime brokerage clients take a lot of space on your balance sheet. One of the most innovative and important improvements in the quality of counterparty risk management has been promoted by these capital regulations. And Stephen mentioned that. It's called compression trading. And Stephen passed over it briefly, but let me explain what it is. It's a really ingenious method of doing the same amount of intermediation, having the dealers intermediate the same amount of swaps, but have less swaps on their balance sheet. How do they do that? Well, once Morgan Stanley, Goldman Sachs, JP Morgan, Credit Suisse, UBS, and all these other banks have built up significant swap positions with their clients and with each other, they'll have a lot of long and short positions that they don't really need, but eliminating them might be complicated because they're with different counterparties. Entrepreneurs, one of which is called Trioptima, developed software. This is a brilliant Swedish engineer that came in with this software and said, you give us all of your swap data, bilateral, by counterparty, and we will find unnecessary circles of swap positions that are redundant in the sense that you're long and short, the person that you're long with is also long and short, and so on through the network, we will find those unnecessary loops, and we will automatically generate a trade in the reverse direction that lowers everybody's outstanding swap positions without changing anybody's risk position. And they've done literally hundreds of trillions, now over 700 trillion in volume of these swap compression trades, crushing down the total amount of swaps in existence without reducing the amount of swap intermediation or volume of trade that's done. That's one example that would never have happened without the capital regulations, because when the capital regulations were light, the dealers were building up these giant positions. Now that the capital regulations are more in the right direction, they feel the benefit of reducing the amount of capital hogging unnecessary positions on their balance sheets, and they found this and other methods like central clearing to get rid of those unnecessary positions. So the capital regulations have done a lot of good through financial engineering and innovation of this type. I think I better stop here.
Okay,
Thanks,
great.
Debbie.
So Tobias is our last speaker.
So I'm the outlier on the panel in that I have slides. So I'm at the International Monetary Fund. I just started there on Tuesday after having spent more than a decade at the New York Fed. So the work here is done with co-authors from the New York Fed. Of course, the views that I'm expressing are my own and those of my co-authors, but not necessarily those of the Federal Reserve, the International Monetary Fund, or FINRA. I'm mentioning FINRA here because we are using FINRA data, very specific to FINRA data for what I'm going to talk about. Many of you have heard that market participants have raised the flag about market liquidity. So, for example, in the Wall Street Journal from last year, it was reported that 3/4 of institutional bond investors say that liquidity provided by bond dealers has declined in the past year. And similar sentiment is expressed relative to the state of market liquidity since the financial crisis. There's a perception that market liquidity has declined. And this photo, I think, illustrates the decline in market liquidity very nicely. So this is a photo of the largest trading floor in the world. On the left-hand side, this is the trading floor in 2008. And on the right-hand side, it's the same trading floor in 2016. And so if you imagine you're a trader and you went from the left picture to the right picture, clearly, it feels like there's less liquidity. I mean, a lot less people around, and there's just a lot less activity going on. So very clearly, something very dramatic has changed, and so I'm going to try to explain a little bit what's going on. So here's another way, a less anecdotal way, to look at the very dramatic changes that have going on. So this is pulling the aggregate dealer balance sheet size from the flow of funds for the U.S. So this is basically looking at the subsidiary level, taking the total dealer assets, aggregating them across all U.S. financial institutions. And what you can see is that, similar to most economic time series, those assets of the dealers used to grow exponentially before the crisis, right? I mean, GDP grows exponentially, consumption grows exponentially. Economic time series generally grow exponentially. And then we have the crisis, so there's a crash. And now the amazing thing in this series is that after the financial crisis, we don't go back to an exponential growth path. We are just like on a complete stagnation, right? And I think this is pretty unique. I mean, when you look at GDP, when you look at banking assets or credit growth in general, all of them, had a crash, but then they went back to an exponential growth path. Now, the rate of growth might be a little bit lower, but there's some exponential growth. Here with the dealer assets, there's just no growth at all. So this is very shocking, and I think it should make us worried, and it should, raise the question that Darrell and Steve were talking about, which is, do we know what we're doing, and what are the kind of causes of this? So the possible drivers that have been mentioned, so some have been mentioned already. Of course, regulation is one of the things that is mentioned often, and usually people, many people are saying regulations have adversely impacted market liquidity. There are, of course, also voluntary changes to dealer risk management practices, right? I mean, the financial crisis revealed a lot of knowledge about how markets work and how much risk is taken, and practices changed. There are dramatic changes in market structure going on that I'm going to talk about a little bit. And then there's the landscape of institutional investors has changed dramatically as well. So asset management firms are becoming more and more important relative to the dealers. And then, of course, finally, expected returns are different today than they were in the run-up to the crisis. So I'm going to look at each of these points in more detail in the next 10 or 15 minutes. So my outline is to first take a deep look at the regulatory drivers of market liquidity. So this is actually new work that probably most of you have not seen. Then I'm going to go over evidence of market liquidities, which is something that some of you might have seen. This is the work that we have done at the New York Fed. In particular, there's going to be a tension between point number 1 and point number 2. So in point number 1, I'm going to show that regulations, I'm going to show evidence that regulations have an impact on market liquidity provision. However, that's a cross-sectional result. In the aggregate, you don't necessarily find that. And then I'm going to talk about alternative drivers for the stagnation of the dealer balance sheets. And finally, about funding liquidity, which is something that Darrell talked about as well. So this is just like a timeline of regulatory reforms as they matter for the dealers. So So I'm not talking, about OTC derivatives specifically. I'm really talking about, prudential regulation for dealers. So, there's Basel III, there are the stress tests, there's LCR, liquidity coverage ratio. There are CVA adjustments, there's the leverage ratio, there's the GSIB surcharge, there's TLAC, etc. There's a lot of stuff going on, a lot of regulations, and they're phased in over different periods of time. So, for all the PhD students here and all the, researchers, there's a lot of ground to do really, really great empirical analysis. In this paper with Nina Boyachenko and Or Shakar, both from the New York Fed, we take one particular shot at that. And so we use the regulatory version of the trace data. So this is the trace data for corporate bonds. So this is collecting every single trade in every single corporate bond, US corporate bond that there is. And the regulatory version of that gives us the dealer identity. So we know which trade of which bond is done by which dealer. So we can construct, for every trade, we can construct dealer-specific liquidity metrics, right? And so then we can basically run a difference in difference regression or parallel regressions that are like difference in difference regressions, where we basically look at interaction terms between the tightness of regulatory constraints and dealer provisions, right? So we can basically ask, well, is it true that the dealers that are relatively more constrained are providing relatively less liquidity as the regulations are phased in? So it's difference in difference. So you're difference across dealers over time. So I'm only giving you sort of like the very broad overview of the study. And so basically what we're finding is that, yes, there are very significant effects here. So dealers that are providing relatively more liquidity, when they are more highly levered, when they have higher trading revenue, when they are able to have higher liquidity mismatch on the balance sheet, if they're more vulnerable as measured by COVAR, which is like a vulnerability metric, etc. So basically, if you're able to take on more risk, then you are better at providing liquidity, which is exactly the kind of intuition that people have, and which makes sense within the context of the picture that I showed you of this trading floor that has compressed. So the basic setup, so this is just the first sort of like unconditional regression. So basically, on the left-hand side, we have liquidity, and then we're putting on the right-hand side, some controls, as well as the constraints, which are like leverage, risk-weighted assets to total assets, net repo, loans, ROA, trading revenue, liquidity coverage, etc. And you can see that there's a lot of significant stuff here. And then you can see that these effects vary very strongly and very significantly over time. So this is basically the setup for our difference in difference study. And so we can test whether these effects are changing pre-crisis versus post-crisis, or pre-crisis versus crisis. And here again, you can see that liquidity. So the degree to which these balance sheet metrics impact liquidity provision change very significantly pre-crisis to crisis, and they change very significantly pre-crisis to post-crisis, and in particular, pre-crisis to implementation period. And economically, these are large effects. You can look at our paper. These are very significant and large effects. So basically, our contribution here, so this is the first bullet point, is to show that the post-crisis regulatory changes impact the degree to which constraints allow dealers to provide liquidity. So this is exactly consistent with what we hear from market participants. Similarly, Bessenbinder, Jacobson-Maxwell, and Venkaratram show, using the very similar data set, they show that there is substitution of dealer capital allocated to trading from regulated to non-regulated firms, right? So there's some substitution going on across firms. So this is also very consistent with our finding. The study one later, Bao, O'Hara, and Zhu, which is the study that Darrell already mentioned, also does a similar difference in difference study on liquidity in the corporate bond market. And they argue that it's the Volcker rule in particular that impacts the pricing of corporate bonds during times of downgrades. So as you're downgraded from investment grade to high yield, your liquidity is relatively worse now than it used to be, and they argue that this is consistent with the Volcker rule. Even though you have to keep in mind a lot of regulations have happened at the same time. And then the Boyachenko, Gupta, and Yen study, which is a very nice paper that all of you should read, that is really looking at funding liquidity. So this is asking the question of whether the widening of the CDS bond basis, which is something that I'm going to talk about in a little bit again, can be explained by the supplementary leverage ratio. And they argue, yes, that is so. Now, at the same time, there are other studies, such as Trebing Zhao and some work that I'm going to show in a moment, that is just looking at the aggregate liquidity. And when you look at aggregate liquidity, the picture looks different. So let's take a look at that. So here we also use the trace data. So we're going to look at corporate bonds first, and then the treasury securities next. So here I'm showing the realized bid-ask spreads in the corporate bond market, right? So this is basically looking at whether a bond is sold or bought, and you look at the realized bid-ask spread, and we're breaking it down by size, so micro, odd lot, block, and round lot. So these are different sizes of trades, and you can see that the patterns, even broken down by the sizes of the trades, is very, very similar. The pattern is basically that bid-ask spreads widen during the financial crisis, then reverted back to pre-crisis levels and are lower today than they were prior to the crisis. Okay, so bid-ask spreads in the corporate bond market appear to be lower in the aggregate on average than they were. The next is to look at price impact. So this is looking at Armut Mendelssohn's price impact metric. And, if you have the Kyle model in mind, this is sort of like, what you should be looking at in terms of liquidity provision. Here again, you see that price impact deteriorated in the run-up to the crisis, then improved and is now better than pre-crisis. When you look at corporate bond trade size, you also saw a deterioration and then an improvement. Now trade size hasn't gone back to pre-crisis levels, but of course, corporate bond issuance has been enormous and the relative composition of the corporate bond market has changed. And when you look at corporate bond volume, that continues to grow. So there doesn't seem to be some structural break here. Now moving on to the treasury market. So in the treasury market, the bid-ask spreads. So, just parenthetically, I'm looking at corporate bonds and treasuries because this is where the dealers are the most important, right? These are the main OTC markets. So looking at treasury markets, bid-ask spreads widened during the crisis, but then reverted to pre-crisis level, and they're basically at the minimum tick size. When you look at treasury depth, so treasury depth has deteriorated recently, but the deterioration is very closely associated with two important events. The first being the taper tantrum in 2013. So from the max, the first very large drop down is the taper tantrum. And then the second very large drop down is in October 2014, which is the flash rally, the treasury flash rally. So the timing sort of like doesn't line up with regulatory things. It's really about other stuff going on in the treasury market. So depth is lower than at the peak, but it's still much better than during the crisis. And trade size, also has come down a little bit, but is still fairly large. And price impact is historically low. So it's as low as it has ever been. So this sort of like leaves us with a paradox, right? Because in the study, in the difference in difference study, I told you that there's very significant, statistically and economically significant effects across dealers and over time. So dealers that are relatively more constrained provide relatively less liquidity. However, looking at the aggregate evidence, I told you, there isn't really, aggregate liquidity really hasn't deteriorated. Market liquidity really hasn't deteriorated. So how do we square this evidence? So one thing is, of course, the difference in differences is really about, cross-institution effects, not necessarily about aggregate effects. And secondly, in all of this, we only measure the trades that actually occur, right? And so perhaps in the parallel universe, so much more trading would have taken place, right? So if you remember, the picture of the trading floor in 2008 and 2016, if in 2016 the trading floor still would have had as many traders as in 2008, perhaps you would have seen that much more trading. And this is, of course, something that we cannot address using this kind of empirical work. You would have to write on a structural model. Finally, there might also be alternative drivers of dealer balance sheets. So it might be that aggregate liquidity hasn't declined, but the decline in dealer balance sheets might not be due to regulations, but might be due to other drivers. So I'm just going to look at 4 of those. So the first one is the voluntary change in dealer risk management practice. The second is changes in market structure. The third is changing landscape of institutional investors, and then expected returns. So dealer risk management practices. So one of the striking things is that the leverage of dealers also has undergone a structural break. So leverage of dealers used to be very pro-cyclical. So I've done a lot of work on the pro-cyclicality of dealer balance sheets. And you can see after the crisis, as we recovered, the economy recovered, financial markets recovered, credit supply recovered, asset pricing recovered, leverage hasn't recovered, right? So leverage has gone down. And the decline in leverage does line up with a decline in total dealer balance sheet size. Now, importantly, the massive decline of leverage was prior to any regulatory changes, right? So, so if regulatory changes impact leverage, it's really that they inhibit the increase in leverage in some sense. But, there are other things going on as well. So when you look across dealers, so this is like looking across dealers, and I'm plotting here the change in dealer balance sheet size in the run-up to the crisis against the change in dealer balance sheet size after the crisis. And you can see a very negative relationship, right? So basically the dealers that expanded most in the run-up contracted the most post-crisis. And many of those institutions are the European institutions. So the European banks, in the run-up to the crisis, they were like, we want to have a big trading floor in the US, and we want to be part of, the great securitization machine. And so they went in there massively, and they got massively burned, and now they're retrieving, right? And so this is not something about regulations, it's just something about learning, learning how to play the game and, being burned. And then, you get in, you lever up, and then you're like, whoa, this hurts, I'm getting out. And so, this is part of what's going on here as well. And, when you look more closely at the names, you can see what I'm talking about. Now, the other thing, of course, that is going on is high-frequency trading. So, just the trading technology has been changing very rapidly. So here I'm showing you returns to market making as measured by reversal returns. So here we take minute-by-minute reversal returns on the Dow 30. So on equities, and you can see that there used to be huge returns to very stupid reversal strategies in the 90s and early 2000s, and they have been completely competed away. Now in the crisis they reappeared, but then they went back to being nothing very, very quickly. And in equity markets, basically there are no reversal returns, and and so this is just illustrating that high-frequency trading has become very important, and in the treasury market, that has become an extremely important fact. So something like 70% of volume in treasuries is now done by principal trading firms or high-frequency trading firms. Another thing that is going on is that asset managers have become a lot more important. So for example, in the corporate bond market, the share of mutual funds the share of mutual fund ownership has gone from something like 5% to nearly 20% over the past, since the financial crisis. And that has implications in terms of competitive pressures on dealers and the way that liquidity formation is done. Finally, one picture that has been circulated a lot are the corporate bond positions of the dealers. So this is the blue line. So many people have pointed out that when you look at corporate bond positions of dealers, you see this dramatic decline, and then the corporate bond positions just keep going down. So this is reflective of the overall total assets of the dealers. What people typically don't point out is that there's a mirror image with the treasury positions, right? Actually, at the same time as the corporate bond positions contracted, treasury positions shot up, right? So it's really like a spread trade, right? So the way it looks is that the dealers in the aggregate had put down a massive spread trade that got unwound. And so, this is sort of like suggestive that perhaps it's not just about regulations, but it might also just be about changes in expected returns. And as a matter of fact, when you just plot the share of debt securities, so treasuries, corporates, municipals, etc. So the share of total debt securities on dealer balance sheets as a share of total assets. So debt securities as a share of total assets, and you overlay that with a proxy for expected returns to fixed income assets. So what I'm using here as a proxy for expected returns is the 10-year treasury term premium plus the BIA AAA credit spread. Okay, this is something like, a proxy for like an intermediation margin. You can see that those things track extremely closely, right? So at least to some extent, what's happening on dealer balance sheet is not just related to regulations and external constraints, but also just, related to, what kind of returns people expect. And that, of course, goes back to the whole issue about securitization and, the possibility of neglected risk. Now, so what I argued is that, well, market liquidity in the aggregate hasn't deteriorated dramatically. And then some people say, well, what about funding liquidity? Has funding liquidity deteriorated? And Darrell has already pointed out that the repo treasury spread has widened. Another thing that people point to is that the CDS bond basis has become somewhat negative, so that's the blue line, or that the 10-year interest rate swap spread has inverted. It's negative now. So these are sort of like things, if you have balance sheet capacity, this is like, and you can hold to maturity, this is like a riskless, there's like a riskless arbitrage opportunity, right? Because you can buy the bond and hedge the risk in the swaps market and make a profit for sure. The problem is you need to have balance sheet capacity. And apparently people in the marketplace don't have that, so these spreads continue to be inverted. Now, the thing is that, those indicators do suggest that there's something about funding liquidity, but there are other funding liquidity indicators that don't indicate that there are problems. So, for example, the Treasury spline error, right? So this is basically, in fixed income markets, you fit a spline, and then things that are cheap are below, and things that are expensive are above, and then they put on arbitrage trades. This is sort of like the typical LTCM type trade. And so with Treasury spline errors, you don't see any deterioration whatsoever. Or another spread, is the Treasury RefCorp spread. So RefCorp is, the agency that was left over from the savings and loan crisis. And so the credit risk of the RefCorp bond and the Treasury bond is exactly the same. And so they should have the same price. And so, that hasn't deteriorated very much either. That arbitrage trade. So, finally, and this is my last plot, this is all like relating market liquidity and funding liquidity. And so as a proxy for funding liquidity here, I use just total securities financing by the dealers. So this is total securities financing that is done by dealers. And as market liquidity, I use treasury bid-ask spreads. And what you can see is that there's a tight correlation between market liquidity and funding liquidity during financial crisis, but not outside of financial crisis. So even if, funding liquidity, even if we did believe that funding liquidity deteriorated to some extent, it's not clear that that has an adverse impact on market liquidity in normal times. In crisis, perhaps, but in normal times, it's not clear. And so I'm running out of time, so I think the last thing that perhaps we can bring up in the discussion is, since the financial crisis, there have been 3 stress events, right? The taper tantrum in 2013, the flash rally, the Treasury market flash rally in 2014, and then the liquidation of Third Avenue, a high-yield corporate bond fund. And I would argue that none of these, these were all big events, but none of them indicate that there's fundamentally something wrong in markets relative to liquidity. Like prices adjusted massively, but it didn't cause systemic effects. I mean, things were sort of like pretty normal.
Okay, thank you very much. I think where I'll start, since that was all very provocative, especially the last talk, of asking the panel whether you want to respond to anything that other people on the panel have said.
Well, let me add just 1 or 2 points to what Tobias said. First of all, I agree that there are so many changing factors through this period that it's hard to ascribe the changes in market liquidity that we've seen to specific regulations or even to regulation in general. It's difficult, but at some points you need to use your judgment. When leverage in the dealers goes down that much, is it a reduction in the demand for trading, or is it something about increase in regulation? I mean, the evidence it's a judgment call, the evidence, if you put it all together, seems to indicate to me that regulation has been responsible for a reduction in leverage and in some markets for a reduction in liquidity. But is that a bad thing? No, I think it's a good trade-off. We've got less day-to-day market liquidity. We've got a lot more financial stability, and they're connected. We can't simply say that when you change regulation, you don't affect market liquidity, but they're connected. And on average, it's been a wonderful improvement in terms of cost-benefit. Not to say, however, that every single regulation has been dialed to exactly the right level, and I indicated one in particular that I think doesn't achieve an efficient outcome, but it's not a finished story. There's a lot more work to do, and we shouldn't be too quick to judge whether regulation is an important factor. We should continue, as Tobias said, all those PhD students in the audience should continue to look into this in narrow, more surgical strikes. And I'll leave it there. Thanks.
Stephen?
Yeah, a few further points that occurred to me listening to the other panelists. I think one is that the central role that a handful of too big to fail banks occupied in our capital markets in the decade preceding the financial crisis, I think should be viewed as a historical anomaly rather than the ideal norm. And a lot of I think the discussion revolves around just assuming that the decade that led up to the financial crisis, that's how things should look. And I think we should instead be striving for a system that has a greater diversity of participation and a greater distribution of risk. I think weaning our capital markets off the dependency they learned about being dependent on bank balance sheet is obviously going to be difficult, and it's only logical that there's going to be some short-term pain associated with that. But I think if you went back and looked at the 80s or 90s, there's a reason that the SEC had a regulatory regime that governed broker-dealers who are active in the securities markets. The notion that all the big broker-dealers need to be part of bank holding companies, I think, is strange. And it wasn't really a facet of our capital markets until the late 90s when you had a pretty substantial wave of consolidation, and you created these I don't know what, financial supermarkets. And then there was a further kind of maybe unavoidable wave of consolidation that occurred post-financial crisis when, Bank of America, picked up Merrill Lynch, and J.P. Morgan picked up Bear, and, Wells and Wachovia merged. So the combination of those two, I think, has created a lot of concentration in the banking sector. But then since the banking sector occupied and had acquired a lot of the broker-dealers that were active in the securities markets, we got this concentration. And then I think they've also, we can debate how nefarious their motives were in doing this, but they were also created a lot of financial market infrastructure that put barriers to entry around the capital markets businesses that we were active in. And so the weaning process also involves kind of opening up a lot of those pieces of financial market infrastructure, be they trading venues or clearing venues, to allow more people to participate. Bank holding company affiliated versus independent doesn't mean regulated versus non-regulated. We do have a regulatory regime that should govern how non-bank affiliated broker-dealers operate, and there's capital requirements and supervision associated with that. So, so how do we get there? And I think, some of the points I made earlier, and I think Darrell touched on them as well, is there's evolutions in trading protocols that allow markets to become more all-to-all. So there's no reason in many of the markets that we're discussing that, the end user or buy-side community should always be the price taker or the person sending the RFQ, and the person that earns the bid-ask spread is one of a handful of dealers. So anyone, should be able to be a price maker and a price taker. And if we look at our more efficient, deep liquid markets, the equities markets and the futures markets, they have that central limit order book model where anybody can put up a resting quote, and others in the market can trade against that. And so in those markets, you have the incidence of two quote unquote non-dealers meeting each other and executing against each other is quite a bit higher. Now, not every product has the right degree of standardization and liquidity to trade on a central limit order book. And so there are other trading protocols that rightly do exist, be they, RFQs or auctions or workup sessions. But, to the extent that there's a greater ability for all market participants to participate in those types of trading protocols, I think gets us a long way towards making the efficiency of intermediation, the efficiency of the price discovery and the risk transfer process, and it not being dependent on a handful of large players. I think the debate over the current state of fixed income market liquidity is, as shown, has a lot of contours and a lot of complexity to it. Again, comparing conditions in the decade prior to the financial crisis to what we see today may not be a fair comparison, and I think probably people have struggled to find the right data or indicators to try to think about how things looked in decades prior to the 2000s. But I'm not necessarily alarmed by the halt in the growth of bank dealer balance sheet. I think it's fair to say that liquidity may well have been mispriced in the years leading up to the financial crisis. One thing that always, if secondary market liquidity in corporate bonds were so bad, people would stop buying them, and people are not stopping to buy them; they're being bought in record numbers year over year. Part of that is a function of the current interest rate environment, and kind of the abnormally long period of record low interest rates. I think has cast its own at a minimum, shadow over all these discussions about trying to untangle what is or isn't driving changes in fixed income market liquidity. I had a chuckle at the UBS picture because I used to work there at the time the first picture was taken, and now I work at Citadel, and so we can draw our own conclusions about whether new entrants are coming into the market and effectively competing against some of the old incumbents and who's winning or losing in that battle. But I think that there's an important role for new entrants to play, and there should be others besides the firm that I work for that hopefully will come into this market. I think that takes time. I think there's we're still not even in the second half, I think, of this reform and change to how our financial markets look, operate, and are regulated. So I think we're far from reaching new equilibria points where new sources of private capital come in and capitalize new entrants who may be non-bank broker dealers or non-bank actors who have an appropriate role to play in the capital markets. There's a reason why the banking sector is different than the capital markets, and there's not a one-size-fits-all regime that should be applied to both. And then I guess I'll close with one final point that I find quite interesting. There's a strong link in my mind between having a healthy single-name CDS market and a healthy corporate bond market, and I actually think that one of the sad things is that the reforms to the single-name CDS market are not at all complete, and it's a striking contrast that we have a index CDS market that has been mandatorily centrally cleared since 2013, mandatorily trades on swaps execution facilities since 2014, and then the highly correlated single-name CDS product that that effectively underlies it is still we don't have central clearing mandatory anyway, and we don't have trading. And I actually think if we could get those reforms implemented in the single-name CDS market, we would actually liquidity and pricing in that market would improve, and it does two things. It provides then a more reliable hedge for a cash corporate bond. So in that way, it can increase liquidity in the corporate bond market because both market participants and market makers, if you have a reliable hedging instrument, you can, quote and trade more confidently. The other thing is that the relative standardization of the single name CDS contract versus the proliferation of CUSIPs associated with any given corporate bond issuer means that the single name CDS product, due to its standardization, can provide an important reference point for pricing. So it can provide a much more effective mechanism for price discovery to occur, which allows people to then transact in the cash product with greater confidence that they know what the price should be when they're buying or selling.
Great, thank you very much. We have time for some questions. There's a microphone up here, so if people who would like to ask a question might want to come forward to the mic, because this is all being recorded. Please.
Hi, thank you, and great panel. What have we learned about lags since the crisis? We've made a lot of new policies, new regulations, and maybe buried in here somewhere is some information about timing of putting in the regulation. Mutual funds would be one example. People had a lot of lead time for there, no surprises. Other ones, maybe less lead time. I mean, this is probably more geared for Tobias and Darrell, but what do you think we've learned from lags, or what do we know about lags now that in policy making that we didn't know before we put in all these new regulations?
Well, I think Tobias, having worked at the Fed, has probably got a better perspective on this. But from my point of view, the regulators in the U.S., actually in Europe as well, have given abundant amount of time to markets to prepare for the imposition of regulations. Tobias noted that leverage declined immediately after the crisis and didn't recover. Well, I think banks knew that they were going to be subject to significant ratcheted up capital requirements over the next 5 years, and they were. The derivatives reforms were all signaled well in advance, years in advance. The Volcker rule is just now coming into implementation. As you mentioned, the money market mutual fund reforms were signaled well in advance. Took a bit of a while to get started, but as Steve mentioned, the SEC, despite having now 6 years since Dodd-Frank was passed, a mandate to introduce security-specific swap regulations, has yet to do it, which is a bit surprising. So it's not like they just jumped on it as soon as Dodd-Frank was passed and took everyone by surprise. And Europe has actually been going slower than the U.S. in most respects. They're just getting around to finishing their OTC derivatives reforms and money market reforms. And in some cases, they actually went at a more measured pace than the U.S., but in many cases, they've been just going slower.
So it's faster, better?
Well, I mean, harmonization. CFTC and reforms of the interest rate swap market and MiFID reforms in Europe were not synchronized, and it caused a lot of difficulty. Also, mutual recognition of central counterparties caused a lot of difficulty. So faster is not better, but harmonized in every case. But harmonized is definitely better.
I guess I would, on the flip side, if the CFTC hadn't gone ahead and gotten these reforms in place, I don't know where we would be with any of it. So I agree. I think it's disappointing that we started phasing in central clearing of interest rate swaps in the U.S. in 2013, and Europe didn't get there until 2016, and is now even second guessing whether it should be delayed for a broader swath of counterparties than are covered by it in the U.S. And we implemented trading reforms for interest rate swaps in 2014, and at best in Europe they'll come into effect in 2018. So coordination and harmonization would have been better in that context, but that doesn't, I guess I wouldn't, my conclusion isn't that we should have waited until 2018 to implement our trading reforms.
I agree.
Uncleared margin actually provides an interesting example of where there was this Basel IOSCO working group on margin requirements that was created to come up with a global standard and a agreed upon global implementation schedule. That implementation schedule was designed to be phased in between September of 2016 and September of 2020. Market participants were given ample notice of that, but come September 2016, the handful of dealers who were going to initially be affected on that first date, the dog had eaten their homework in many cases. So at some point in time, you do need a deadline, and you do need to tell people to stick to the deadline, because a lot of the hard decisions, a lot of the commercial negotiations that are needed to make some of those reforms work don't occur until they have to. And so you do get a little bit of people saying these things can't be done, but then given a firm deadline, people prioritizing it, allocating the right resources, putting the best minds to work, do get these things done. And then the last point, sorry, is that when deadlines shift too often, so for example, if you're told, if you're operating a client clearing business and you're told mandatory central clearing for clients is going to happen in 6 months. So you invest a bunch of resources, you hire teams, you build the infrastructure, and then the regulator delays it for 2 years. Well, you're going to go and jettison that, and 2 years from now, you're going to say, do I really want to build out this client clearing offering again? Because last time I did it, I just wasted a bunch of money and the regulator punted the deadline by 2 years. So it's hard to, some certainty and some firmness of deadlines is also needed if you want to actually incent the right commercial response to adapting to and implementing the regulations.
Yeah, I would side with Steve on this point as well, and I would use bank capital to illustrate the point. So in the U.S., banks were forced to recapitalize very quickly after the crisis in 2009 through the first round of stress tests, the SCAP program. And so the banking sector was recapitalized quickly, and so confidence in the financial sector and the banking sector in particular returned very, very quickly. My reading, and these are my own views, whatever I'm saying are my own views and not representative of the institutions that I am working at or have been working at. I think that in Europe, the recapitalizations have been much slower. I mean, there's of course some differentiation across countries. Some countries have been aggressive and quick, while other countries have dragged their feet. And I think that is still hurting them. So not recapitalizing quickly can be very, very costly going forward, and it can distort the ways, future incentives to address regulatory issues. So I would agree that reforming quickly is probably valuable in many circumstances.
Other questions? I'm going to ask one of my own, which is the unthinkable a few months ago is now on the table, which is a repeal of Dodd-Frank. And you've been talking mostly about the fact that these regulations have actually helped the markets. So I'm curious whether you think if the regulation now was repealed, if these regulations were repealed, would you see central clearing go away, or is it actually something that the market test has proven is going to be beneficial for the markets?
Well, I actually think that the financial market participants like central clearing now that they've paid all the costs to set it up. The benefits are pretty clear. There might be some naysayers, but I don't think there's enough impetus to take out central counterparty as viewed by many as one of the success stories. There may be some other items in Dodd-Frank that could fall, but not that one.
Yeah, I tend to agree that the Title VII of Dodd-Frank, which is the OTC derivatives reforms, is generally well implemented and has been successful, as I noted. And it's not, objectively, if you look at the Financial Choice Act that House Financial Services Committee Chair Hensling introduced last summer, which had a lot of proposed changes to Dodd-Frank, and was fairly aspirational at the time in terms of what they thought they could, signal or message or get done. It didn't really touch Title VII. So I think there are a lot of items in Dodd-Frank that will be in focus this year. I don't think the OTC derivatives elements are. I think there's been a lot of focus on the Consumer Financial Protection Bureau, the Financial Stability and Oversight Council, and the systemic designation process and thresholds. The Volcker Rule gets attention. Risk retention for securitizations gets attention. So, but I also don't think that the undoing, or anything that's perceived as friendly to Wall Street is still probably not going to be too politically popular. So I don't think it's going to be one of the first priorities either in the new administration. So.
There's a question there.
So I think in general, as a research agenda, I think studying trade-offs more carefully is immensely valuable for policymakers. You know, in policy processes like the Basel Committee process, the FSB, in rulemaking processes, academics always have a voice, and but they haven't really been able to you know, come up with good cost-benefit calculations so far. And I think that's a real opportunity for the economics profession to contribute to this debate, and it's something that is really needed, because if those calculations aren't there, then people, you know, come up with their own numbers. And there are trade-offs everywhere, right? And so, you know, there's the trade-off that Darrell mentioned in between financial stability on the one hand and the cost of credit intermediation. You know, there are a number of models in the literature now that are featuring this kind of trade-off, but, you know, making that trade-off quantitative, I think, is something that we haven't really done yet, both from a micro point of view as well as from a sort of like general equilibrium point of view. But there are other trade-offs as well. You know, there are trade-offs between short-term and long-term costs. You know, you might think that getting the banking system to a better capitalized banking system might have a relatively large short-term cost, but not a long-term cost. And really understanding short-term versus long-term is something important for welfare purposes. And then finally, you know, I think the theme of the big universal banks versus the principal trading firms and the small players, you know, really understanding how regulations impact the differential costs and benefits of trading for those institutions. I think it's something that that is only tangentially studied in the literature, and that is very, very first order in the marketplace.
I would just add one point to that. There's various aspects of market liquidity. The one we usually have focused on, including today, is execution costs. And part of those execution costs are associated with rents for providing financial services. You could have a world in which liquidity is very good in terms of low execution costs, but the rents accruing to those are only available to a subset. And that's why competition in a legal sense refers in part to antitrust, meaning who gets to provide the services, barriers to entry and the like. So we haven't really, that's more in, those legal issues aren't really dealt with directly in new regulation, but they exist on the books, and antitrust rules are important in achieving competition so that we have not only liquid markets, but fair and competitive markets to which all appropriate investors have appropriate access.
Oh, sorry, yes.
Yes, just a brief question. You presented the tri-optimum, I guess that's what it was called, as kind of like a good result of regulatory changes. It just seems to me that it would have been totally unnecessary if you didn't have some weird supplementary capital rule in the first place. And of course, there may be small benefits because there's like a legal complexity that you get rid of, but obviously no one thought it was worth investing so much in creating such a product after the fact. So are a lot of these innovations stuff that would have been redundant if markets were allowed to operate in a reasonable manner?
So Trioptima is, I think it's the prime example of a compression trade service, but there are many others that have been innovating in this space, and they got started well before the financial crisis. But they really got rolling and got a lot of momentum based on, in my view, based on capital regulations. And I think it's, in terms of social welfare gains associated with regulation in the derivative space, it's probably one of the least controversial improvements, because these were literally redundant from the viewpoint of creating a market exposure, the trade that you want. These swaps, getting rid of these swaps did not change anyone's actual market position, just reduced their counterparty risk. The capital requirements, by adding those, it was enough to tip the balance towards developing and deepening that machinery and going deeper and deeper into the books of the dealers, getting rid of more and more stuff that was unnecessary. So I think that that was a great innovation, and there are others of similar types that have been happening that probably would not, they would have happened anyway, but not to the extent that they have.
Yeah, and it's you know, if you owed your neighbor $100 and he owed you $120, you wouldn't even have a second thought about just concluding that, you know, there was a net obligation that he owed you 20. But the problem is when you have, you know, separate legal contracts in place that were executed at different times, you know, they stay on the books and records of these firms, and even if they offset, there was no neat way to just do that logical netting out that you would just do in your head. And so, you know, if you don't clean them up, you just ends up with, you know, millions and millions of line items that you still have to account for on a daily basis and calculate margin and mark to market on a daily basis. So it creates a huge, you know, independent even of the capital implications of, you know, any notional based test that makes it, you know, insensate. There's, you know, operational risk reasons why you'd want to, you know, do as much compression as possible to clean things up. And then, you know, in the event that one counterparty does go insolvent, you know, if you have, you know, 100,000 line items against an insolvent counterparty, but they could have been reflected with, you know, economically 1,000, you'd be in a much better position of kind of managing that insolvency process, you know, if you had a much more, you know, cleaned up, so to speak, portfolio. And, you know, it featured most prominently originally in the kind of inter-dealer market, but, you know, clients' demand for access to compression services is quite high as well, and Trioptima has been expanding now to include buy-side, and the different CCPs are trying to come up with their own buy-side offerings as well. So there's a, you know, I think the benefits of it are as you noted, widely appreciated.
Okay. So there's a question way back there.
It seems truly obvious to say that the regulatory system has a lot of lawyers in it, and the regulation involves sort of communication between economists and lawyers. And I'm wondering if you think, like, what is there to learn from talking to lawyers, and also what do we lose in translation in the sort of go-between between economists and lawyers to get the same group of regulations?
So I find it tremendously helpful to talk to lawyers. So I remember a roundtable, a very small roundtable we organized at the New York Fed with some economists. For example, Oliver Hart was there, some lawyers, and some judges as well. Actually, the Judge Peck, who is the judge of the Southern District of Manhattan Court that oversaw the Lehman bankruptcy, was there. And we discussed the exemption from bankruptcy of repo and derivatives that was expanded with the 2005 reforms of bankruptcy laws. So those reforms that have very economically significant impacts on trading, on the cost of repo and the cost of derivatives, and through the cost of bankruptcy, because with this exemption from the automatic stay, the class of instruments and the class of collateral that is exempt has been expanded or was expanded dramatically, and thus lowered bankruptcy costs by making those instruments effectively super senior. And much of those debates are done among lawyers and lawmakers, with economists having very little say in the debate. And I think economists should participate in those debates. I mean, Darrell is one of the very few economists that has a voice in those debates and who actually calls us with lawyers on those types of topics. And in my own work over the past decade at the New York Fed, I found that really getting into the depth of institutional details and that includes talking to lawyers is tremendously useful, and there's a lot of economic insight that can be earned.
There's some back there too.
There's one issue that the panel didn't even touch on, and it's been a narrative in some markets, which is the issue of collateral scarcity, especially for government securities. And this has been particularly relevant in Europe, where some GC repos are very, very negative, but you also see evidence of it in the United States with the increase in fails that has been documented by the Fed, and the increase in also specialness. So I was wondering, that wouldn't usually be a regulatory issue, but rather one of monetary policy. And I wonder what the panel's thoughts of the relevance of that change may be.
I wouldn't call it, so it has monetary policy implications, but it's not per se a monetary policy issue. So at the New York Fed is overseeing a treasury markets practices group that has been in effect for many, many years, where market participants get together to address issues such as the fails issues. It has monetary policy implications because, of course, monetary policy is implemented via repo and via or outright purchases. And so market functioning is extremely important for monetary policy. But of course, it's important for Treasury as well, and for funding costs, and as a benchmark security, the Treasury market should be working. So that when you see the spikes and fails, you do worry. And so the venue is the TMBG, the Treasury Markets Practices Group. That is really the first order group that is working on that.
Oh, over here.
So I think it's useful to take a historical perspective on that. So when you think back on sort of like important historical, important institutions that with respect to financial stability or regulation, such as the creation of the Federal Reserve, the creation of the Federal Deposit Insurance, the National Banking Act of 1860 or so, those are all outcomes of political negotiations. And they are triggered by particular historical events, just as Dodd-Frank was triggered by a particular historical event. However, those institutions or regulations are not created out of thin air by those politicians, but they rely on a debate that might have gone on for decades, right? So for example, the Federal Reserve was created after decades and decades of debate among economists and lawyers and other political thinkers about whether a central bank should be created or not. And as a matter of fact, economists argued that it shouldn't be created. I think that in retrospect, people are, pretty happy that the Federal Reserve was created. So I think that even though it's true that regulations are negotiated, they are negotiated relative to an environment of ideas that is very much influenced by the thinking of economists. And so I think a problem occurs when economists haven't thought through issues, right? So I think there are lots of issues that economists hadn't been thought about. It's like these trade-offs between financial stability and market liquidity, or financial stability and the cost of financial intermediation, right? It's something that, as an economic profession, we should have had good answers prior to the writing of Dodd-Frank. And because we didn't have it, it didn't influence. But had it been there, I think it would have influenced. So, the kind of knowledge and the thinking that is out there, I think does have a distinct impact on those negotiations, even if they're done by people who are not necessarily economists.
One, little anecdote I'll add is I think from an economic perspective, I think nobody would say that index CDS should be regulated by one regulator who writes their rules differently and at a different pace than the single name CDS market. But so one unfortunate, political compromise that was made, though, was to bifurcate the jurisdiction of the, that portion, the credit portion of the swaps market between the CFTC and the SEC. And so that's an instance where, because of that political compromise, we have a less than optimal output for how that market is currently functioning. So,
Okay, it's hard for me to see. Are there any other hands up there? Oh yeah, there's one. Okay.
I was just wondering whether you could very briefly comment on the level of complexity of regulation, whether you think there is sort of maybe a trade-off also related to how complex regulation is and how maybe hard it is to understand financial markets and the financial market to relate.
I'm sure everybody on the panel has a view on that. Famously, Dodd-Frank is very complex, but that's legislation. That legislation then goes through implementing regulations, which are far more complex, but are not as subject to the political process that Tobias and Steve just spoke about, in the sense that even though each regulator has its own politics, at least they don't have to go back to Congress to get that those regulations adapted to the new environment. And that happens all the time. So in that sense, you would like to give the regulators some discretion to make the more principles-based regulations and adapt the sort of by case law applications as they arise. That's maybe best case. In the real world, Congress proscribes fairly heavily. That's why Dodd-Frank is so long. And then the regulators themselves tend to write relatively detailed regulations, in part because the financial markets of the 21st century are extremely complicated, and trying to get the intent of Congress into a small number of lines of regulations is generally quite difficult. So while I don't think regulations are as simple as they could be or optimally are, I'm not surprised that they're as complicated as they are once Congress lays down the law saying, for example, the Volcker rule, you must permit market making, but you may not permit speculative trading that's not intended to serve your clients. Getting that into a regulation is a really complicated thing to do because it's a principle. It's very hard to implement. If on other topics, like central clearing, for example, while there are issues about which swaps must get centrally cleared, what that means is relatively less squishy, and you can do it with fewer lines of regulation. So I guess it's a case-by-case situation, and an imperfect process. It would be nice if they were simpler.
I think the one point I'd add is you don't want to the extent that a regulation is supposed to make a market more, open and accessible, you don't want the complexity of the regulation itself to be its own barrier to entry. So if the regulation becomes so complex that, the costs of understanding it and complying with it preclude, people from, entering a market that they would otherwise like to enter. So, that's the balance that I would focus on.
I think there's a little bit of a chicken and egg problem, right? Because on the one hand, regulations are very complex because financial markets and financial institutions are so complex. So simple regulations are not sufficient to get at the complexity of trading and the complexity of banking. So you really need very refined rules to capture the complexity of the marketplace. But on the other hand, of course, those complex rules then make financial institutions and trading more complex. So it's sort of like this endogenous process where, things are becoming more complex. And if you want to control risk, you make things more complex. If you want better compliance, you make things more complex. So, the problem is it's not, just saying, well, we want to simplify everything is not necessarily the right answer because it's not, then there are these gaps that are opening up because the complexity in the regulations is there for a good reason. So it's not a simple question, but it's another question that I think people have started to do some research on. And I think serious work on those kind of topics is extremely useful and really necessary.
I think there's a question over here.
I guess we talked a little bit about electronic trading platforms for public apps, but I guess there is also dramatic change in terms of other new technology and new combination with some financial innovation, like the introduction of new payment system, the introduction of the software, new lending, a lot of things like that. And obviously, the introduction of those technology can have some lot of new challenge to the regulatory environment. So I wonder if you could give us a little bit of idea regarding looking forward to how we think about regulation in terms of the influx of new technology and new combination of financial information.
Well, high-frequency trading is the poster child of that question. That's changed. Tobias mentioned, for example, that about 70% of Treasuries trading is now done by principal trading firms, which generally use high-frequency trading algorithms. I don't think that's that and the flash rally of October 15th, 2014, nor the April flash crash in the equity markets of 2010. I don't think those are unrelated to the importance of high-frequency trading and understanding how our markets now work. How do you regulate that? I think we haven't really made much progress in terms of high-frequency trading offers a lot of benefits. It offers a lot of costs. It's a completely new technology. We don't have rules really that are adapted to that, that's a great one. Bitcoin is another one. I mean, I don't think it's as big of an issue for the USA as for China, but it's something that the Fed has actually looked into. I don't think it's currently in need of a big regulatory environment, though.
Yeah, I think the fintech revolution, so to say, I mean, does ask a question: what is a bank? At what point in time does a fintech firm become a bank, right? So, you know, fintech does payment system through things like Bitcoin and other forms of payment. There is credit intermediation that is done in the fintech space. So these are domains that are traditionally done by banks. And the challenge for the regulator is to ask, you know, at what point do we call this thing that is going on a bank? And should the same regulations apply or not? And there again, I think the answers are not entirely obvious. And this is where good research can contribute to the debate. I mean, this is a debate that is going on already and that will be going on for many years. And getting the answer right is extremely important. And you know, welfare analysis is what should be used to answer those questions.
Okay, I don't see any other hands.
I think we exhausted
We've
them.
exhausted the audience, so please join me in thanking the panel.
Thank you.